fundsupermart.com.
Hi, what is your house view on Chinese equities?
Yeung, who's the fund manager of the China Focus Fund, has a cautious short-term outlook on the Chinese economy, but is very positive in terms of the reform agenda that the government's put in place. Yeung also feels that investors should have a balanced approach when it comes to new versus old China. So if we look at the old China sectors, she's actually finding a lot of value in some of the unloved state-owned enterprises and also finding some very interesting opportunities in unloved sectors such as heavy industrials. On the flip side, when we look at some of the new China names, she does feel that, for example, IT, the valuations are looking a little bit expensive and it's become a bit of a consensus trade. Having said this, though, there are a number of names in her portfolio that are beneficiaries of rising consumer wealth in China, as well as a shift from offline to online retail.
What are the challenges that China face in the mid to long term?
If we look at the medium term, sentiment's still quite negative towards China in terms of slowing growth, in terms of GDP growth that is, as well as slowing credit growth. We do feel, however, that investors should be focusing on this reforms agenda that the government's put in place. And long term, we do think it's going to be very positive for China as long as the government's able to manage slower growth, as well as really looking at the reforms in both financials, for example, as well as across the whole economy. So longer term, it's about whether the government can shift their GDP model from moving away from exports, fixed asset investment, to an economy driven more by private consumption.
Do the economic and political reforms made up by the Chinese government have any impact on the fund, and how does Fidelity manage the impact?
In the China Focus Fund, the reforms agenda that's being put in place by the government is playing through in a number of holdings. So, for example, Yeung is finding some interesting opportunities within the financial sector, such as life insurance companies. So, for many years, the life insurance companies were out of favour, but now due to positive regulation, the fact that insurance companies can diversify their holdings or their exposure to, for example, property, it's beneficial for their overall balance sheet.
We were greeted with weak economic data from China at the start of 2014. In your opinion, apart from the attractive valuations, are there any other compelling reasons for Chinese equity investors to stay on the course?
When we look at the reforms agenda again, we do think it's very positive, and so the government's addressing a lot of the problems such as capital misallocation that's been building up over the years. So, it's a positive long-term process, but it is a long-term process. It's nothing that's going to happen overnight. Also, when you think about China, given it's the second largest economy in the world, when you look at its makeup in, let's say, the MSCI World Index, China, including Hong Kong, makes up less than 3%. So at some stage, we do think that the MSCI index or equities indexes, as well as capital market indices, will need to be rebalanced so to better reflect China's economic status in the world.
In terms of the fund sector's allocation, what has worked well so far, and do we expect this to continue?
Over the past quarter, so Yeung took over managing the fund in October 2013, really a lot of the consumer-related names have benefited from performance. As mentioned, though, it's not just the consumer names that are driving performance or that are the big names in the portfolio these days. A lot of the unloved sectors where we're seeing some companies trading at very attractive valuations but still have some good upside are also included in the fund.